At checkout, a $200 purchase can appear to shrink. Instead of paying $200 today, the screen offers 4 payments of $50, no interest, no visible annual fee. The merchant can ship the product without waiting for the plan to finish. If the customer is not paying extra, and the store is being paid up front, the obvious question is also the hidden one. Where does the money come from? The short answer is that the 0% offer is not free. It is a financial machine built between the customer and the merchant. Money enters through several doors, risk leaves through several others, and the company in the middle tries to keep the difference. To understand the business, we have to follow one purchase from the checkout button to the balance sheet. Start with the classic product. Pay in 4 usually divides a purchase into an initial payment and 3 more installments, often collected every 2 weeks. The customer normally pays no interest. That simple promise is the version most people recognize. It is also only one part of a much larger product family. Companies also market shorter loans with different schedules and longer installment plans that may charge interest. Federal Reserve staff estimated that 6 major providers issued about $156.7 billion of buy now, pay later company credit in the United States during 2025. Half was pay in 4. Across the broader total, about 37% carried an annual percentage rate. Even the narrower product is enormous. Data collected by the Consumer Financial Protection Bureau from 6 large providers showed 335.8 million pay in 4 loans in 2023. Their nominal value was $43.9 billion, with an average loan of $131. This was a 6-company sample, not a complete census of every provider. Now follow a typical transaction. A shopper selects pay in 4. The provider makes a rapid approval decision. Under the standard checkout flow, the provider pays the merchant up front, minus the applicable contracted fee. The merchant can fulfill the order without waiting for 4 installments. The provider then collects the scheduled payments from the customer. That merchant fee is the first major revenue stream. For classic pay in 4, it is foundational. But it is not the whole business, and it is not the same across every merchant, provider, product, or distribution channel. Large contracts are usually private. Any claim that the entire industry charges one universal rate would create precision that the public evidence does not support. One public example shows why merchants notice the difference. At the time this script was locked, Stripe listed a successful Klarna transaction in the United States at 5.99% plus 30 cents. Its listed price for a successful domestic card transaction was 2.9% plus 30 cents. That is Stripe's public list price, not Klarna's universal fee, and not an industry average. Why would a merchant pay more? Because the merchant is not buying only payment processing. It is also buying financing at checkout, upfront settlement, and a structure that may transfer defined credit and fraud risks under the contract. Research published in the Journal of Marketing studied one large American retailer and associated buy now, pay later adoption with about a 9 percentage point increase in purchase incidence and roughly a 10% relative increase in purchase amount. That study does not prove that every store earns more than the financing costs. It does explain the sales argument. Installment framing can make the immediate price feel smaller. More shoppers may complete a purchase, and some may spend more when they do. The merchant pays for a chance to improve conversion and basket size. Whether that trade works depends on the merchant's margins, customers, and contract. The gross fee is not profit. The provider must process payments, detect fraud, fund receivables, service customers, collect missed installments, absorb credit losses, offer incentives, and comply with different rules. Every one of those activities consumes part of the revenue. A 6% checkout price shown by a processor cannot be treated as a 6% profit margin for the lender. Affirm's filings reveal how many revenue doors can exist inside one company. For the 9 months ending in March 2026, Affirm reported about $3.1 billion in net revenue. Roughly $848 million came from its merchant network, $209 million from its card network, $1.48 billion from interest, $431 million from gains on loan sales, and $127 million from servicing. The company Affirm is not a template for the entire industry. Its figures include products beyond classic plans with 4 payments, and another provider can have a very different mix. That is the central mistake in many simple explanations of this business. Merchant fees matter. interest can matter. Card revenue can matter. Subscriptions, advertising, consumer fees, loan sales, and servicing can matter. The answer changes with the company and the product. Loan sales add another layer. A provider can originate or purchase a receivable, then sell that loan to an investor or move it through a securitization. Selling can release capital for new transactions and may create a gain on sale. The provider may continue collecting payments for the new owner and receive servicing income. Depending on the structure, some obligations or risks can remain. Before a loan can be sold, someone has to fund it. The merchant is paid before the customer completes every installment, so the provider needs capital during the gap. Affirm has used warehouse debt and securitizations. Klarna reported that consumer deposits supplied 90% of its funding in 2025. Funding design changes the cost of the machine, especially when interest rates or credit conditions move. Then there are losses. In the Consumer Financial Protection Bureau's 6-company Pay in 4 sample, the loan-level charge-off rate fell from 2.63% in 2022 to 1.83% in 2023. Charged-off dollars equaled 0.92% of gross merchandise value in 2023. Those are portfolio measures, not household survey results and not credit card comparisons. Late fees are another place where the simple story breaks. 4 of the 6 surveyed firms charged them. Among those 4, collected late fees equaled 0.18% of gross merchandise value in 2023, and 4.1% of loans received at least one late fee. The evidence does not support saying the whole industry is mainly a late fee business. Individual companies can still build meaningful consumer revenue. Sezzle reported that merchant and partner income produced 29% of its 2025 revenue, while subscriptions produced 22%. Its filing also described several consumer fee categories and on-demand finance charges. That is Sezzle's model, not a license to assign the same mix to every provider. For consumers, the attraction is real. The payments are smaller, approval is fast, and Classic Pay in 4 is usually interest-free. The risk is also real. In a Federal Reserve survey conducted in October 2025, 16% of American adults said they had used Buy Now, Pay Later during the prior year. Among users, 26% said they had paid late. The same survey found that 11% of users said a Buy Now, Pay Later payment had triggered an overdraft or insufficient funds fee at their bank. That is not the same as a fee charged by the provider. It is a reminder that a zero-interest loan can still create costs when an automatic payment reaches an account without enough money. Multiple loans can also become difficult to see as one obligation. Consumer Financial Protection Bureau matched data from 2022 found that 63% of borrowers had multiple simultaneous Buy Now, Pay Later loans at some point. 33% had simultaneous loans across multiple firms. These figures describe borrower behavior and correlation. They do not prove that the product caused financial distress across the population. The legal map is just as fragmented as the revenue map. In May 2025, the Consumer Financial Protection Bureau withdrew its 2024 interpretation that had treated certain digital Buy Now, Pay Later accounts as credit card accounts under a federal lending regulation. The withdrawal removed that interpretation. It did not erase every federal or state law that may apply to a loan, a lender, or a deceptive practice. States are moving on different tracks. New York enacted a licensing and supervision framework in 2025. On July 15, 2026, its Department of Financial Services formally published proposed implementing rules. The proposal addresses licensing, disclosures, fees, disputes, reporting, and data protections. At script lock, comments were due in September, and the rules were not finally adopted or effective. California takes a more established position. Its financial regulator describes Buy Now, Pay Later plans as loans. In an earlier enforcement settlement, the state required a point-of-sale installment provider to obtain a California financing law license. That settlement involved one company, so it should not be presented as a universal ruling on every product or contract. Congress has considered a broader federal response, but consideration is not enactment. A House Buy Now, Pay Later protection bill introduced in December 2025 was still at the introduced and committee referral stage when this script was locked. A related Senate bill was also still in committee. Neither status should be described as federal law. So how does Buy Now, Pay Later really make money? In Classic Pay in 4, The merchant fee helps finance an interest-free customer offer. Across the broader business, providers can also earn interest, card revenue, subscriptions, consumer fees, gains from selling loans, and fees for servicing them. Against that revenue sit funding costs, processing, fraud, collections, compliance, incentives, and credit losses. The hidden margin is not one fee. It is the spread created by a network of merchants, consumers, banks, deposits, credit facilities, and investors. The customer sees 4 smaller payments. The merchant sees a completed sale. The provider sees a receivable that can be funded, priced, serviced, and sometimes sold. The product feels simple because the complicated part has been moved behind the checkout button.